started. A worldwide currency crisis is teetering on the edge of complete economic collapse of these countries. Markets are trading on borrowed time. Interest rates just said F you to the tech stocks that Cathie Wood owns. Have you noticed Google and Amazon stocks didn't even make it up to their 200-day moving average in this year's rally? The reason why is there's a liquidity shortage in the system. These two are both $1 trillion mega cap giants. It takes a lot of capital to move them up. So the market maker, in order to trick you into believing the Goldilocks environment we are in, they sell those mega caps and pump that money into other smaller large cap or mid cap growth stocks. Now it seems that's over as the S&P 500 has recrossed the 200-day moving average heading south. USD is picking up strong bullish trend and momentum. Why the dollar shortage crisis is teetering on the edge of complete economic collapse of countries around the world. Why you should be prepared for the biggest crash of your lifetime today. I will explain it all right after this. And of course, smash the like button. If you want to be my good boy, apply to write your first book with me. Welcome back everyone to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here. And you know what to do. And push my button if you like what you see in today's video, because I can't push it from this side. This video is brought to you by my Patreon. If you are a good boy, go to patreon.com/magicalgoddesscheryl to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing. Author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want to get into the bookstore. You want it to be real. You want it to be true. You want to be my client, don't you? Before I take you to the Mordor, the land of the shadow, and tell you the terrible news, I do have one piece of good news for my Canadian subs. The Bank of Canada announced Wednesday it would hold its key overnight rate at 4.5% after 8 consecutive interest rate increases. And experts said the pause could last throughout 2023 as the bank watches the economy responds to its policy moves so far. The question now is how strongly Canada's debt-saddled economy responds following months of aggressive monetary tightening. What likely comes next for the Bank of Canada is a very long nap, in the sense that interest rates are unlikely to change over the balance of 2023 if the economy performs as we expect. The Bank of Canada's communications also highlighted a very tight labor market and said inflation expectations still need to come down further for inflation to get back to 2%. We can see USD to CAD is very close to the high of last October, when stock market made a low, and when we move back to March of 2020. Before the crash, USD to CAD was crashing higher too, signaling stocks are about to crash again. Now we get to the scary part. Hospitals delaying surgery in Sri Lanka. International flights suspended in Nigeria. Car factories shuttered in Pakistan. In some of the world's most vulnerable developing nations, the situations on the ground are dire. Shortages of dollars are crimping access to everything from raw materials to medicine. Meanwhile, governments are struggling with their debts as they chase rescue packages from the International Monetary Fund. It's forcing a rethink of the bullish emerging market consensus that swept Wall Street just a few months ago. Granted, few expected the challenges facing certain frontier economies to be remended this year. But pain has deepened alongside a rebound in the greenback. While trouble at the fringes of the developing world is unlikely to drag down the asset class as a whole, some say it will force money managers to be increasingly tactical in their investment allocations in the months to come. There's a real crisis brewing in these troubled nations, and for some, things will still get even worse. Investors will need to be even more vigilant in screening for vulnerability and differentiating country risk to avoid being surprised by the next Ghana or Sri Lanka. In Pakistan, factories have halted operations in the past months as they ran out of hard currency to import raw materials. In Sri Lanka, the government set a limit of 20 liters of fuel per person a week. And government hospitals are postponing non-urgent surgeries due to the shortage of drugs and other medical supplies. That's not to mention the international carriers that suspended flights to Nigeria due to the difficulty in repatriating dollars from the nation. In Bangladesh, power producers are seeking $1 billion of foreign currency from the central bank for fuel imports to avert a looming energy crisis. Malawi, too, is facing a shortage of pharmaceuticals, fertilizers, and diesel amid declining imports due to the dollar crunch. JP Morgan Chase Next Generation Markets Index, which tracks the dollar debt of which it calls pre-emerging countries, posted a 0.4% drop last month, the biggest since September. And amid the dollar's recent vigor, currencies from Ghana, Egypt, Pakistan, and Zambia have crumbled far more this year than their peers. That has some money managers embracing more careful approaches. A break from the broad emerging market optimism seen at the beginning of the year. These countries are mired in economic collapse. And some, like Pakistan, are teetering on the edge of another default. Major parts of their economies are struggling. The currencies are worth far less too. Frontier markets may continue to face external challenges this year, including a still strong US dollar, high yields, and difficulties in accessing the bond market. Fitch Ratings wrote in a report Monday. A decline in reserves also has the potential to lead to more credit rating downgrades, it warned. More risk-averse money managers, meanwhile, are instead hunting for attractive yields in debt from governments that have managed to keep their fiscal deficits in check and currencies relatively stable. Barclays PLC has pointed to Mexico and Colombia, as nations heading toward further fiscal consolidation. Dangerous cycle. For nations such as Sri Lanka, the trouble began years ago as officials spent valuable hard currency reserves to keep local exchange rates artificially high. But it was Russia's war in Ukraine and the Federal Reserve's aggressive policy tightening which drove the dollar to generational highs, that pushed many frontier economies closer to the edge as soaring energy and food prices drained their coffers. It's tempting to say there's an EM crisis because of the Fed's tightening. But that takes human agency away from policymakers in select countries that were enacting unsustainable fiscal policies. That said, tighter financial conditions are now exposing policies in some of these countries that are proving unsustainable. About 24 nations are lining up for aid from the International Monetary Fund. Though progress has been slow for nations hobbled by debt negotiations, the year has already seen several debt-laden countries, including Egypt, Pakistan, and Lebanon, drop their exchange rates as they attempt to unlock rescue funding. With currency traders bracing for a potential wave of devaluations, for Brendan McKenna, an emerging market economist and strategist at Wells Fargo Securities LLC in New York, those who are willing to take the risk can find opportunity in countries with a clear reform agenda and a path towards support from official lenders such as the IMF. Pakistan, Sri Lanka, and Ghana maybe now is not the time to deploy capital there, he said. But Egypt could be an opportunity if the IMF program is successful at supporting the economy while tough reforms are implemented. As you can see, people are suffering all over the world. This debt-based system is a trap. Dollar is created out of thin air in the banks. The Fed can print it digitally, but you need to pay it back with interest. Interest is rising. If you don't pull out at the top, you will get burned on the way down. They are hiding the truth in plain sight, using inflationary data to cover up the rolling recession truth happening all around the world as we speak. And here is my client Teddy Eazzy's book. It's called Wicked Pussy Perfume. It is a femdom novel. It is about money, the stock market, and stockings. So order your copy today. And my client's collaboration book, it's already yours, Adversity Equals Success. Another amazing book with incredible authors. You are such a good boy for watching my video right till the end. Bye.